Hello, Maverick traders. Welcome out to your currency midweek for August 31st. Corey here with you. Nice to see all of you. As always, a quick reminder to make sure that you follow your trading plan, and let's get to it. So, plenty happening in the markets, more so maybe on the stock and that area than FX. We've talked about how FX is in a little bit of a wait and see mode, but let's try and make sense of this together. So, a few weeks ago, I talked about that, and I've shown this chart for the past few weeks, the 50 period or the 50-week moving average in the S&P, and how we're still in a bear market as in my view and by definition, we're still below the 200-day moving average if you prefer using that long term. The basic idea is more not an exact point, but more a collection of things. And the collection of data suggests we're still in a bearish market. So I emphasized that a couple of weeks ago, and sure enough, the markets have fallen hard since then. Inflation has peaked, but it's still far too high, even though it's going to come down. And you're going to see an annual inflation rate start to tick down to 6% and 5%, well above the Fed's goals. Now, interesting, quantitative tightening really begins in earnest right now. When the Fed was doing bond buying programs, remember that bonds have a maturity date. So let's say that they buy a 2-year bond. Well, that means that in 2 years, that money is paid back to the Fed, right? And so what the Fed had been doing is every time a bond would mature, they would take that money and roll it into a new bond, and they would constantly be cycling it through. And they called this sterilized quantitative easing because they weren't printing new money, they were using the existing money, and that still created that effect. Now they were printing some new money as well, but they were kind of also utilizing the money that would hit maturity. They would roll that back in and keep our interest rates artificially low, etc. Well, the Fed is not doing that anymore. And so that has a natural shrinking of their balance sheet. That, remember, they have $9 trillion of debt. And so it's going to start shrinking to the tune of hundreds of billions of dollars. That's a good thing. I look at that as a very, very positive thing. But it's one of the factors that, again, is going to be tough for the markets. You can't argue and really believe that the market was going up for many, many months on the back of, the Fed printing money, and then in the same breath say, well, this quantitative tightening is going to have no effect. Of course, if the easy money policies were pushing asset prices higher, when you take away the punch bowl, asset prices will have a tendency to come down, would be the expectation, and certainly that's my expectation of how this will play out. US dollar remains strong. We're right up against resistance. The euro's having a nice bounce back week. We've gone back above parity. It's about the only currency that's moving so far this week. The US dollar is just at this pivotal spot where you have to wonder, do we stay or do we go? Do we break out or do we fail at these levels? We'll look at some charts and analyze the prospects of that. Most commodities have rolled over. Energy has been the lone holdout, and I've really loved energy. It's the one commodity that I think has that long-term effect. But even energy got hit this week, specifically in Europe. If you've been watching energy prices in Europe, they have gone absolutely parabolic. I mean, that chart is just sky high. And Europe has an energy crisis. Well, they kind of had a big exhaustion move, and now they've come down sharply. I mean, 10% drop in energy prices in a single day is pretty historic. So we're kind of in that exhaustion, and now we're kind of falling back. My best guess is that we initially fall hard and then we consolidate. What do you do when you're exhausted? You take a rest, right? So we're going to give back most of this last rally, which is a pretty good amount, right? A big sharp decline. And then I think it will just level off. I don't see a ton of downside for energy, but I do think it got carried away on the upside. Economic reports this week, consumer confidence bounced back, And why does the consumer, by the way, some of these confidence numbers have been at like 50-year lows. But why did the consumer confidence number jump back up and people feel better? Well, because the consumer is looking at one thing, and that's price tags, and looking at one thing, and that's kind of inflation. And the price and inflation rates have come down a bit. You're seeing a little bit of a drop, specifically at the fuel pump. Energy, oil prices have been more in the 90 range versus the 100, the 110. You're seeing gas prices, which tend to have a lag effect, but gas prices have started to come down. So the consumer just kind of had a little bit of a rebound that way. And I think you could almost mirror gas prices going up and consumer confidence is going to be lousy. If gas prices roll over a bit, consumer confidence will bounce back. I think they're a perfect inverse correlation that way. And I think that really is the reason, the main and sole reason why consumer confidence bounced back here in this recent number. US ADP employment comes out the Wednesday before non-farm payrolls, and a bit of a disappointment, 132 versus 300. Non-farm payrolls is far more impactful to the markets, and that comes out on Friday. We're going to be trading that, of course, but this gives you a little precursor, and so far, that's a disappointing number. If the non-farm payrolls has a similarly big miss and disappointing number, it will be interesting to see how markets behave and react on that news. One would anticipate that a big disappointing number might be a really negative for the US dollar, because that would be one more reason for the Fed to kind of slow down on rate hikes and say, "Hey, we don't want to completely demolish the economy," and so on. So, if there's a big mess, I guess you'd have to kind of think that the US dollar is going to roll over temporarily, and kind of the knee-jerk reaction would be to sell the dollar, I would expect. All right, returns for this week. Everything in the red, SPX, the international markets, gold, and oil, with the exception of crypto. Crypto is the only thing up, and that's not up a ton. For crypto, up 3% is not a huge move, but definitely the best performer out of the group. So here's the S&P 500 chart in the short term. This is a daily chart, so you can see we're below the 20, which is now kind of importantly rolling over. I really pay close attention to slope of things because it gives you a sense of kind of the directional pull, right? Moving averages are rolling averages, and price is pulling them. And right now, price is kind of pulling that one down. The 50 is still kind of sloping up, and then you got the 200 up here, and it's all a mixed bag. And when you start getting moving averages this close together, and you got some up and some down, what are you in? Well, I think exactly what we're in is a consolidative market. Do we immediately go down and take out these lows? I don't think so. Do we immediately go screaming and take out the highs? I don't think so. I think this is going to be a period of confusion and choppiness here for a while. So how do you trade choppy and back and forth markets? Well, interestingly enough, it's kind of counterintuitive, but let's say, hypothetically, let's draw up a picture. What might happen here? Well, we just broke the 50. What if it intensifies? What if today kind of sells off a little worse? And then maybe even tomorrow, maybe as soon as tomorrow, you just get a big selling day. I would look at that as an exhaustion, as a flush. Because if I expect that we're going to be in a range-bound market, let's color that in red, I'd look for one of these at an extended point. See how we've already been falling, and then you get it? That would be like, people are being pushed past their limits. They're throwing in the towel. They've given up on it. And so if we had one of those, I would actually be a buyer late in the day, expecting that, well, now we'll choppily work our way back up. And what might happen there? Well, might not last much, but you might get kind of a bigger bullish candle, some green candle towards the end of a little extended move or something like that. And I'd actually be using the best days and the worst days to probably, fade the reaction. Because when you say you're neutral on something, if I'm neutral on something, that does not mean that I expect price to go like this. Prices don't go like this for too long. It can happen for 4 or 5 days. It could create a high base or a low base, but it's not just going to do this for weeks on end. The only charts that do that are when companies are getting bought out and they'll gap up towards the buyout price and then they'll just flatline or something. But in most assets, it's not like that. That's not what neutral means. What being neutral or expecting, sideways in some asset means what? Well, it means that you expect that as we move away from a certain level, we're going to come back to it. And as we go away from it, we come back to it. So if you said I'm neutral here, you were right, because even though we extended away, we came back. And even though we extended away, we came back. And sure enough, it was neutral for multiple weeks. That's more of what I'm suggesting here, is that I think I'd be more neutral on the market. So if we get a some sort of exhaustion signal on the downside, I'd be more of a buyer. As you bounce back, if you have kind of the same thing up here, I'd be more of a seller, and I'll just try to use that trendless environment, correct? That trendless environment to kind of fade the this fade the times where people are throwing in the towel. Now here's the long-term chart, and this long-term chart is important in that, as I've said, I've shown this chart for the past few weeks, and we started showing it, whether it was lucky or not, I started showing this right here, that the stock market was in trouble. And the reason I highlighted it right there was, well, that's where it became important, right? We had rallied up, came underneath that 50-week moving average a couple of weeks ago. Remember, each of these candles is 1 week's worth of trading. This shows you we topped out. We've been selling off hard the past couple of weeks. Ultimately, I would expect that we'll go down to that low and probably break that low. I would expect that. But in the near term, I expect this first. Spend a few weeks choppily in this general area, and then another shoe probably drops and we come down here in the months ahead and break those lows. I could see that. That's probably exactly how I see this playing out. But I started showing this chart a couple of weeks ago because, first of all, a lot of people were debating, are we in a bull market, a bear market? What is it? And I said, well, I'm certainly in the camp that we're still in a bear market. I mean, we were right at this downtrend line as well. There were multiple factors in play that were kind of bearish for the market right up at that level. Lower highs, lower lows, down trend line, below a downward sloping 50-week moving average. The 20-week was bearish. It had rolled over underneath the 50, which is bearish. The longer term charts don't look so good. And that's okay. You go through bear markets, right? You go through long extended bull markets as well. Here we were in a bull market for multiple years, right? Here we were in a bear market that COVID knocked us into in late February. We sold off dramatically, and then the Fed came in with bond buying programs. They printed more money. They sent out checks to citizens. I mean, when you start doing that, look, asset prices are going to go up, right? So they stimulated things and got the markets to reverse back up. We're a long ways off of that. We're a long ways off of them initiating a new bond buying program or something. At least I think we are. We should be a long ways off of that, given how much inflation spiked and how wrong they were. They don't have cover to come in with aggressive quantitative easing or anything like that. And I think they're freaked out a little bit by inflation. Inflation is a dangerous thing. I mean, you can lose control of currency values, and it can be kind of ugly. So they've got to fight that, and that's good. They should fight it. I mean, that should be priority number one, is price stability. But the downside of that is that should be very bad for asset prices, and this should reprice at lower levels. That's exactly what should transpire in the coming months. All right, looking at FX, I mean, there's just not much going on with the exception of the euro. And why did the euro bounce back dramatically? Well, it gets to energy. The one factor, I mean, if you say what is the biggest factor to Europe right now, it's energy prices. I mean, it's a full-blown crisis. We've been talking about it the past few weeks. There are those in energy that might have to kind of decide between buying some food and heating homes and all sorts of stuff. I mean, it's pretty ugly how high energy prices are and the lack thereof. They're starting to do things to try to save up, and they're going to be instituting this winter is going to be interesting. You know, sometimes they're they're able to make adjustments. They're able to do things that are uncomfortable for the citizens, but they get through it, and that's kind of how it will transpire. But I would imagine you're going to hear some ugly stories about, you know, what happened in Europe during the winter of 2022 into 2023. So it's a tough spot. It's a tough situation, but the fact that energy fell so sharply, we talked about that exhaustion high, um, that should be good for the euro. It's part of what's been weighing on it. The economics of Europe have been a disaster in this whole Russia-Ukraine policies. You think politics don't matter? Well, policies that Europe enacted that basically made them dependent upon Russian oil and energy were some of the worst policies they've ever instituted, and it has created a crisis. So, you know, it's not a good thing. Why is the Europe bouncing back now? Well, because there is a little bit of reprieve in prices. And so, again, kind of an inverse correlation there, whereas energy and those European energy prices come down, that's good for the euro. Ethereum is the best performer in crypto land, and that has been the case. It's really been the outperforming crypto for since the bottom that happened a couple of months ago. Let's go take a look at a few other markets here. So overall, I would say that we're in a bear market. I mean, I've been steadfast in that. And although we were in a short-term uptrend, I said, okay, that's fine. We call these corrections. You will always have corrections within various trends. And this is a bear market with a bullish correction. So now you're getting a little bit of a reversal here. Does this just roll over dramatically? Like I said, I think the moving averages and I think all these things kind of signal that we're in more of a choppy sideways environment than just a runaway freight train to the downside. But if you're going to make a bet on which way we go sharply, I would still lean towards the downside. But I don't think it's either one. I mean, I would expect we'll rally back in the not too distant future, and people will say, oh, here comes the recovery. And look, we're going to go to new highs. Well, look at how impressive this is. And about the time people get excited about the rally is about the time that will fail. So that's what I would expect is too much downside and you want to be a buyer, too much upside and you want to be a seller. Crypto is just not moving. I mean, there's just nothing going on. I said charts don't flatline for too long. Well, usually it's, you know, at most 4 or 5 days, but in this case, that's a very sideways pattern, but really within a very sideways environment for crypto overall. So not very exciting to trade that space. Let's take a look at the rest of this week. We get CPI. If you're trading the Swiss franc, that's happening overnight tonight. In the US, we have ISM manufacturing PMIs. Anything above 50 shows growth, and that's expected. And then non-farm payrolls on Friday, which is really the big event in economics for this week. If non-farm payrolls disappoint. Now, they're already expected to go down. You can see the expectation is last time we had 528,000 new jobs, this time 295. But if that disappoints, I mean, imagine this disappoints similarly to what ADP did, which is about 1/3 of its expectation. That would put you at about 100K here. I would anticipate the knee-jerk reaction would be for the US dollar to go down. And in terms of, the US dollar and whatnot, I don't know that it sells off dramatically or anything on that, but I think the knee-jerk reaction would be to the downside. My personal expectation, I usually trade after the number comes out. It's a little less risk, but I wouldn't mind having a US dollar short that I try to get into ahead of time. Imagine we could find a dollar short position today that had a few pips of profit going into Friday morning's meeting. That I might feel more comfortable with because I could move my stop to break even, and either it surges even further in my favor or it surges against me and hits me out at break even or a couple of pips of loss, even if I have some slippage. That's kind of where my thinking is at, is that this non-farm payroll number is more likely to disappoint. It's kind of like we talked about last week at the Jackson Hole, that there was far more likelihood for a disappointing reaction in the markets than an positive reaction. So I think the same thing is kind of true here, where in my opinion, we're more likely to see a situation where maybe the US dollar disappoints, maybe on non-farm payroll, right? So here's the dollar chart. If we break it down, this is versus all other currencies. We're back at resistance. That's on the long-term daily chart. And it's been a big run. I mean, this was a huge run up to establish that resistance. Then you fell back, and now you've come back up. It's possible. Usually when I see a chart like this, I don't think double top. I think cup and handle. That's a possibility. But even if it's going to cup and handle, that means it should kind of fall back. It should respond to this resistance zone and fall back for a day or two to kind of create that little handle effect. That might be all it does, or possible this develops into a double top. I don't usually expect things to become a double top or a double bottom, but anyway you slice it, I kind of think, well, we could look at that for a downside trade. If I turn to the 12-hour, the 4-hour, again, the market's US dollar has been going higher, so most of these charts are still bullish, which is kind of the problem, is we don't really have a short setup or anything in these charts. We'd have to be patient. Now, if we were to glance at some individual charts, it could look a little bit different, because something like the euro, if we start there, we know that the euro has been the strongest currency this week, which means the euro is actually trending higher versus the US dollar. Not on a longer term basis, but on a shorter term basis, right? It's just seeing a little bit of a bounce back. So this one, does it give you a super excited feeling? No, you know how trash Euro USD has been. We're certainly kind of dumpster diving a little bit in looking for some treasure here in Euro USD. That's how bad it's been. It's been left for dead, and we're thinking about trying to play it as though it's going to revive. That's a dangerous game to play. But just pointing out that the short-term trend can be a little bit better in certain things. Kiwi versus USD still in a downtrend. Aussie definitely still in a downtrend. CAD still in a downtrend versus USD. Notice now USD is listed first, so it's still up versus where was it? Swiss franc. US dollar versus the Swiss franc still trending upward in USD. So let's go over here. We could look at a couple others that we haven't looked at yet. Guess we looked at euro. We looked at Aussie. We didn't look at dollar yen, but that's still going to be, dollar's still in an uptrend. Pound, yeah, pound USD, and the pound's still in a downtrend versus the US dollar. So, I mean, the only one that even could give us a consideration right now in terms of the chart is Euro USD. That's about it. I would think about it. I'm not in a mega hurry or something, but I would think about it. You can see that Euro's giving you a pullback right now versus the US dollar. This might be sort of interesting. I mean, look, it is retesting the breakout zone. You can see it broke out. It broke out on with aggression and with some energy, and now it's retesting to see if that's good and can hold this level and bounce. Could be up for consideration if nothing else. Outlook on gold. So gold, I mean, with US dollar being as strong as it is, you're just going to be in a bear market in gold. So let's go to a long-term chart of gold, GLD. And if we back this out even further, you can see we've, from that big exhaustion high, that was the peak, that was it. And we've collapsed lower in gold prices, gone from, 1800, 1900 an ounce down to, 15, 1600 an ounce, that sort of thing. A few hundred points, a few $100 per ounce lower in gold versus where it was. Longer term, I don't know. I mean, we've looked at some different things as possibilities on a longer term basis, and I actually have a bearish position in gold right now in GLD. So I'm playing it to the downside. But having said that, I'm not against thinking that we could experience some reversal. It's just a question of when and where. Euro Kiwi we had a request for. So here's the daily chart, and you're starting to emerge, getting above the 50. It's trying to change trend. We've been in a bear market, a downtrend in Euro versus the Kiwi. It's trying to turn into an uptrend. If we just glance on it at a couple of different time frames, I mean, you can see the bounce. You can see that the trend is higher in the short term. And, my inclination would be to continue to trade it in that direction, to look for buying opportunities, for setups. You recently had one. Hopefully everybody kind of recognizes the pattern, the formation. When you establish a key level and you go back to retest it, you often get that kind of effect, right? You can call this a cup and handle. You could call it an ascending triangle. They're often the same, kind of the same pattern, the same principle and idea, right? That you're stalled out, but you can see the buyers are there because they're buying at higher levels than they were before. They're keeping that price within that upward trend, and then you get the break. So good stuff. Yeah, I like it. I mean, Euro is the thing that's moving. It has the energy. I'm always a little concerned in this type of environment because, and I would be inclined to oftentimes take more aggressive profits. It's counterintuitive, but if I was to say that, let me give you two charts. Okay, chart A is like this, and it's just starting to break out, and you're a buyer. You got in right there. Okay, this is chart A. And chart B looks like this. And it's just starting to break out right here. And you got in as a buyer. Which one has more upside generally? Which one do you think can really take off to the upside and has the most upside? Well, the reason I say it's counterintuitive is anybody that's new whether you admit it or not, you would naturally think that B has the most upside. And the reason you think B has the most upside is you can see how far down it's come. And so you kind of think of things like gravity. Oh, it's come down a lot. It's going to go back up a lot. But, you think that there should be huge upside in B, but there's not. A has massive upside potential, limitless in some ways. Why? It has no supply. Who has bought A and is disappointed? Who's in a bad position? Who wants out? Who's just waiting for a price to sell? Nobody. Nobody has a bad position in overhead supply. B has massive amounts of supply. As this thing tries to go higher, all of these people want out, and these people that bought higher, and these, and these, and these. You see how you have all these, bad positions, all this overhead supply, all this dead weight. So as this thing tries to break out, it encounters all of this supply. And I always say that A is Michael Jordan. You remember Michael Jordan could jump from the free throw line and dunk it. And I was in, so I'm in my 40s, but I was in kind of my heyday in Jordan's heyday. I was in high school back in the 90s, early 90s, when he was just killing it and so on. So Jordan was always, you ask me, Jordan or LeBron, I'm going to say Jordan because I saw him in his heyday. But this is Michael Jordan. He has no problem. I mean, he's just free to fly, right? This is Michael Jordan, but you've just stacked all this weight on his shoulders. Okay, you just piled on hundreds of pounds of weight. And now you said, okay, jump from the free throw line and dunk it. There's just no chance, right? So that's what tends to happen is, I'm always hesitant to buy strength and buy breakouts in a chart that's like B because it just has all that overhead supply. And that's the problem you have with Euro charts. Make no mistake. Every Euro chart has some overhead supply. It's got disgruntled former buyers. Now, you always have potential supply. Remember, supply, or people that were looking to sell, you always have supply from those that bought well, right? Those that have a profit. Well, that can come from anyone. Anyone that bought down here might be looking to sell or whatever. You always have supply coming from those that want to take profits, but you don't always have supply from those that are disgruntled and bought poorly and are in a losing position. This is, a circumstance where something's gone down a lot. Then you have two forms of supply. If something is going up, you only have one form of supply, and it makes a huge difference. And oh, by the way, something that's going up, people lose their appetite for selling because they regret every sell they made. Think about Bitcoin and those things. When they were going up, everybody that sold some along the way regretted it because it went higher. And then if they sold some more, my gosh. And so the market, in a runaway bull market, you get trained to not want to sell, which is ultimately when you kind of convince everyone not to sell, things go crazy on the upside. And that's when you most should sell. That's what we call an exhaustion type of move, right? When things go parabolic and get exhausted and so on, and nobody wants to sell, that's when you got to ring the register. So you got to think through who's in what position. That's what a chart is really telling you. It's telling you where people bought well, where people bought poorly, where you might encounter support and resistance, which is supply and demand and so on. So if you really break it down, you can think through the psychology of the chart, and it'll make for a much better, well-informed decision. So that's my word of caution on Euro. So what do I do in this circumstance? Well, instead of buying breakouts, I buy pullbacks. If I'm playing something that's kind of counter to the long-term trend, then what do? Well, I come over here to Euro Kiwi and I kind of say, let me try and find, like, I would have been more inclined to buy this dip. Might not be so obvious, but I try to buy in, corrections or on support or whatnot. And I don't always trust the breakout. What I bought here on the breakout, hopefully I'm already in. And I probably use the breakout to take some money off the table. That I look at it differently. When I'm in something that has gone like this and then is trying to go up, I'm a pullback trader much more than a breakout trader. Okay. I kind of say, well, I'm gonna do more of this and not that. Now, when a chart is like this, then I don't have all that overhead supply. Okay, now I'm happy to be a breakout trader because I know that that's Michael Jordan potentially with no weight on his shoulders. So good stuff. The strategy choices can help you in that way. So if I'm trading euro, I'm going to look for pullbacks. We looked at euro USD. I'm not really interested in buying on breaks higher, but I am looking at this pullback that is in effect and saying, okay, I buy the dips. I know that I'm going against a lot of overhead supply. I'll try to buy really well at a discount. And then when people get excited, I'll take some money off. And then when it dips back, I can put it back on and so on. I'll be a pullback trader and I'll use spikes and surges to take profits. And that's worked well for me. All right. So in summary, now we are missing one date here, it looks like, but we'll be sending out a transitioning from summer trading recording. Nice class to talk about how we're going into the fall. Historically speaking, the fall time period is much more volatile, so be aware of that. We'll have a preview video coming out tomorrow, previewing Friday's non-farm payroll report. We'll also have, as usual, our currency recap. And then for whatever reason, I'm not showing it on there, but on our schedule, remember we're trading live Friday morning, the payrolls report. So come and join us if you'd like to be there and trade that with us. Have a great rest of your week. We will be back next week, same time, same place. Goodbye, everyone.